Hello everyone and welcome to Moementum channel. In this video, I'm going to take a close look at the key reasons why I think the company Bionano Genomics with the ticker symbol BNGO is not perhaps going to be a good investment option for many investors out there, and why I'm not going to invest in this company. Well, as you know, there has been a lot of hype and interest around Bionano Genomics stock. In fact, the value of the shares for Bionano was up by 3 times and since the end of December. That said, today the stock finally got a hit and went down by over 30%. What we're going to do in this video, we're going to talk about why I think the Bionano Genomics stock is a very risky investment option, and why I think actually it does not deserve the price tag that it has right now in the stock market. For those of you who might not be aware, the Bionano Genomics stock was offered as an initial public offering in the stock market on NASDAQ back in September of 2018. And at the time, the value of the shares went up all the way to around $8. But since then, the stocks started a slow decline. And by early 2020, the value of the stock was already under $1. In fact, since April of 2020, the company was not meeting the requirements to be listed on NASDAQ because the value of their stocks has dipped under $1. So the one big news around the company was that late in December, they got an extension of 180 days from NASDAQ to remit the requirement to be listed on NASDAQ by having their value of the stock going over $1. So that was a little bit of a catalyst for the stock. In the meantime, the company had some attempt, in fact, to have a split of their stock. So typically, when the value of the stock goes very low, the company can try to split the stocks. That way, they are, superficially have the stock each valued as double. So in other words, bringing the stock value above $1 threshold. But that kind of proposal was rejected by the shareholders of the Bionano Genomics. So that really didn't pan out. Nonetheless, the company was quite obviously pleased with the fact that suddenly over the past 2 weeks, the stock have caught fire, and at one point the value of the shares went up over $7. So that was quite an exciting information for the company. As I mentioned today, though, the stock suddenly and finally kind of cooled off and went down by about 30%. The reason why I'm kind of very worried about this stock is when the company initially was offered as an initial public offering, they had issued around 4 million units of each company. So that included about 3.9 millions of common shares that was released, as well as 3.9 millions of company warrants. And the company warrants are, it gives the owner of the warrant and the opportunity and the chance to exercise those warrants and convert them into actually stocks. And those stocks would be actually supplemented by the company. They are not actually being provided to them from the existing pool of the stocks out there in the stock market. So we could assume that back in 2018, the company had roughly about 7 million shares. Now, over time, they gradually increased the number of outstanding shares in the market. So by 2019, the number of shares for the company in the market was almost doubled. But the situation got really, really worse this year. Right. So if you look here on the screen, you will notice that how the number of outstanding shares for the company has changed drastically. Back in 2018, we were talking about 7 to 10 million. 2019 went up gradually. We are looking at around 20 million, almost doubled, early 2020, and now suddenly by November of 2020, we're looking at 153 million shares of the company out there. This is a heavy dilution that the company has been, following. As you notice here, when a company issues additional shares of its stock, it can reduce the value of existing investor shares and their proportional ownership of the company. And this common problem is called dilution. And this is not a good news at all for the company shareholders. I'm going to use a simple analogy so that you're more familiar with how dilution is actually a negative phenomenon. Imagine if the company as a whole and its shares are considered to be a pizza. We all love pizza. Who doesn't? And you're promised when you buy a share of that company that you're going to get perhaps one slice of that pizza. Now imagine, for the sake of just an example, imagine if that pizza initially is cut into 4 slices and you're promised 1 slice. So your share of that pizza, of that tasty pizza, is 1/4 of that pizza. Fast forward, let's say in 2 years, you're still promised that 1 slice of pizza. The only difference is that the company now, instead of cutting this pizza into 4 slices, they've cut it into, let's say, 30 slices. Obviously, the value and the amount of pizza that you're going to get from that company, in this case, is going to be a lot lower. So same goes with the dilution. When company actually dilutes its share and issues new shares, as an existing shareholder, the value that you're getting for the same price that you paid is going down and down. And that's why a lot of times when company dilutes its share and issues new shares, the price of the stock typically goes down, because that's not a good news at all for a existing shareholder. And so keep that in mind. Now, as we talked about, 153 million shares is huge. Add to that the fact that the company has been right and left issuing warrants. And warrants, as we alluded to, that allows the warrant holder the right to exercise that and convert that warrant into an actual share. And those shares would be issued by the company, not from the existing share out there in the stock market. And many of these warrants, the price that they are issued for, obviously they have an expiry date, but the price that they have is, a lot of them are under $1. So can you imagine, for many of the warrant holder, they could easily profit at the time where the value of the stocks have gone up so much. Not only they can, take the profit, and many of the times these warrant holders are actually the executives of the company, but as by doing so, the proceeds of that actually goes back to the company. So obviously they use the money to fund the company, but the warrant holders, in this case, aka a lot of the top executives, they're actually cashing out a lot of heavy profits, for as you can imagine. So keep that in mind. In fact, many times I think investors, without doing proper due diligence, they are just making a lot of top executives richer without really looking into the fundamentals of the company. And whether the company is actually doing a lot better, or is it just a hype and news. One other thing that I want to show you real quick, if you look at the form 10Q by the company, and this is a form that the company releases as part of its during its quarterly reports, and it gives really great insight into the company and some important information that is valuable for us to look at. As you can see here on the screen, the number of companies' warrants that they have issued has increased drastically since 2019. Look at the June 30th, 2020, their total number of warrants was around 80 million, whereas by June 30th of 2019, the number was only about 4.2 million. So huge difference here. Lastly, I want to show you a couple of charts that again helps elaborate on my point. If you look at it, the price to sales for trailing 12 months. The company is showing a price to sales ratio of close to 49 at this stage. And in fact, this is one of the highest that it has been, except for, of course, a while ago when the company reached its all-time high price in the past 1 year, which was around 70. But still, look at that. 48 is really an extremely high number. We made a couple of other videos on the channel recently analyzing the company in more details. I would definitely be adding links to that in the description of the video. Be sure to check those videos out if you haven't done that already. But in there, we talk more in depth around fundamentals and the technical aspects of the company. If you look at company's price to book value, you would also notice that their trailing 12 months price to book value is right now at 50. So the company's stock is being traded at 50 times the book value per share. Typically, the higher the number is, the worse it is. That means that the company is being really traded at a premium. Of course, if you're buying a quality product brand stock, you're willing to pay a premium for it. But for Bionano Genomics, for a company that is loss-making, paying 50 times premium on a price to book value, in my opinion, is way too pricey. And you can see in the past 5 years, it was hovering closer to perhaps 14, 13, or 10, or some numbers like that. But suddenly, most recently, it went up as high as 72 times price to book, and then now sitting at 50, which in my opinion is, again, way too pricey. Let me know what you think. Do you own shares of Bionano Genomics? If you do, have you made profits on them? Let me know what you think and what your thoughts are, and what would be your next move when it comes to perhaps investing in this stock, buying or selling it, or perhaps adding it to your watch list. I hope you enjoyed this video, guys. As I mentioned, I'm not, of course, financial advisor, but I've used quality information from the company's reports based on charts and stock market analysis and financial metrics to really put this video together, which I found is beneficial for me to better understand what type of stock I'm dealing with. I hope this video actually provided you with some value as well. And if you did find it beneficial, please be sure to give it a thumbs up and share it with someone who might benefit from the video as well. And of course, please don't forget to subscribe to Moementum channel. Here on Moementum, we post weekly videos about stock market investing, finances, and financial freedom. Thank you, and I hope to see you next time.